For the American banker, and Steve Hagenbuckle, he's a managing principal at TerraCap Partners, which invests in distressed real estate and actually happens to have some ownership stakes in some regional community banks. Good morning, gentlemen. Good to see you guys.
Good to be here.
All right, Joe, let me start with you. You recently wrote an article in the American Banker taking a look at this quarterly FDIC report. Due out later this morning. What are your what will we see?
Well, I think there's certainly hope for improvement on some of the last few quarters. The industry earned a slight profit in the first quarter after a steep loss in the fourth quarter. So I think there's hope for improvement on that. I think there's also going to be some interest in maybe what's some of the other trouble spots that might be impacting banks down the road, like commercial real estate, for example. But I think also this will be interesting to see the state of the FDIC's insurance reserves. They've been resolving a lot of failed banks lately, and so where the FDIC's insurance fund balance is at this point will indicate maybe how many banks might be failing down the road, and also how much the industry might have to pay in insurance assessments.
Yeah, Steve, in part, one of the ways they're trying to address a depleting insurance fund, which for people out there, you should know it protects your is by allowing private equity to get a game, and they made some big decisions yesterday which were very friendly to private equity. What did you make of those decisions?
Well, the new rules were very prudent and fair, and I'm looking at it from both sides. As you know, I'm looking at it from a board member of a community bank. I feel from that perspective the outcome was very prudent. I also feel that they didn't give private equity too much of an advantage. And then from a private equity manager perspective, I think that there were some components in place that are conservative, that force the private equity companies to become partners of the banks longer term with larger capital requirements. And I also feel that it's going to make the private equity guys look more as a partner as opposed to someone that would come in, break up things into small pieces, sell them off. I mean, at the end of the day, we're going to become partners with community banks longer term, and that's a good thing.
Steve, they've done a couple of deals where they've let private equity participate with IndyMac and Bank United, so we've seen a couple of them, but still some of the private equity folks yesterday said, not so sure I still like these rules. Obviously, the capital ratios came down, which was advantageous still for private, but the capital ratios are still double those of traditional banks. It almost is as though they're incentivizing them to partner up with other banks.
That's absolutely right. And I think that could be a very good thing. Good banking backgrounds and experiences can certainly be key to the success of a new venture like this. I feel that the 10% component of capital requirements could be an additional cost of entry challenge, as has been voiced by some of our PE peers. The other thing that's somewhat of concern is the 6-month review and how it could be somewhat of a moving target, and they may change the rules down the road.
Yeah, Joe, there's a lot of uncertainty, of course, about getting in bed with anything associated with the government, but it appears as though the likes of Wilbur Ross and other centers on what these rules would look like for private equity did gain some victories yesterday. But there's still an open question. International banks, will we see more participation from them? Will we see more transparency on the bidding process? What about those issues?
Well, I think there's definitely some questions to be answered and to see how the policy statement will work. The FDIC board did include a provision that said that after 6 months that the policy is in place, it will be reviewed to sort of see how effective it's being. So I think the agency kind of, they passed this guidance, but they also kind of want to make sure to check it along the way to see how it's working.
So would you assume then, Joe, that this removes an important hurdle for the FDIC chair, or is the biggest hurdle that there are some who forecast that the FDIC assessments right now could break into profitability substantially in 2010? I mean, I think Dick Bovee said 25% of after-tax income.
Well, I think assessments are definitely a concern for the industry. Whenever there are bank failures, it means the FDIC is essentially spending money, and when the FDIC is spending money, they need revenue to kind of make up for that loss. But I do think that the policy guidance, the FDIC was hoping to create more certainty, because with more certainty there will be more bidders, and with more bidders it will potentially mean that bank failures are less expensive for the government, and therefore the industry will have to pay less to help the FDIC keep its fund afloat.
Steve, I presume that, look, you have a direct personal stake in banking, and regulation changes, overseas institutions perhaps buying into domestic failing banks are big topics of conversation. Walk me through, what are the biggest concerns that you have today?
With regards to the biggest concerns we have as a bank would be making sure that we tighten up and return to some of the regulations of the past, going back to the 80s, more conservative lending, more conservative investing. I think a couple components that are advantageous though, with regards to private equity, is the 3-year commitment. I also like the fact that they're saying that private equity can't do any affiliate lending. I think that was prudent. They also are really focusing on full transparency, and disclosure. That's very key. And then they're limiting who can actually bid moving forward with regards to special ownership limitations. So if somebody was a party to a failed bank in the past, they cannot bid. And I think that was a very smart move as well. So, overall, I think the new rules and regulations are very prudent and very fair, and a positive step towards the things we've talked about.
All right. Well, gentlemen, we have to leave it there. Joe, thank you very much. And Steve, I appreciate just a programming notes.